Welcome, curious minds, to the deep dive. Imagine a company that's literally building the world around you. I mean, the roads you drive on, the energy powering your life, even the materials for our cities. And for a century now, one company has really been at the forefront of all that. Today, we're digging into Caterpillar Inc.'s 2024 annual report. Now, this isn't just, a dry financial document. Think of it more like a blueprint. It shows that one of the world's biggest manufacturers is handling global shifts, innovating for a sustainable future, and carrying on that incredible 100-year legacy. Our mission, pretty simple. Pull out the key insights for you, give you a shortcut to understanding Caterpillar's core business, their financial health, and their plans to create shareholder value and, build a better world. And just so you know, all our insights today come straight from Caterpillar's official 2024 annual report. That's their Form 10-K. So let's unpack this giant.
Yeah, it's fascinating right off the bat. Just the scale of Caterpillar and their history. They are, hands down, the world's leading maker of construction and mining equipment. Plus, off-highway engines, industrial gas turbines, even diesel-electric locomotives. It's huge. And this commitment they have, to customer success, to new tech, that started way back in 1925. Now it's backed by this massive global footprint. Over half their sales, 53%, are outside the U.S. They've got 152 independent Cat dealers covering about 190 countries. It's not just presence. It's a whole system supporting key industries everywhere.
That global reach is incredible. Must be a huge strength, but I bet it brings some complexity too. Okay, let's get into the nuts and bolts. How do they actually build the world? Let's break down their main business segments. First up, construction industries. This sounds like the core, right? Infrastructure, buildings, rental, quarries, basically the heavy lifting. How did this segment do in 2024?
Right, it's definitely a cornerstone. So in 2024, construction industries brought in about $25.5 billion in sales. That was actually down 7% from 2023. And profit took a bigger hit, down 12% to roughly $6.2 billion. The main reason: lower sales volume to end users. So it seems like a bit of a slowdown in immediate demand for new gear in some places.
Okay, 7% down on sales, 12% on profit.
Exactly. And regionally, it was a bit of a mixed picture. Sales dropped in North America, although interestingly, dealer inventories there didn't build up as much as in 2023. Also down in EAME, Europe, Africa, Middle East, and Asia Pacific, partly due to the weaker Japanese yen, but sales actually went up in Latin America.
Oh, really? Why was that?
Yeah, higher sales volume there. It seems dealer inventory had dropped in 2023, so they increased it in 2024 to meet demand.
Okay, so a mixed bag regionally, but an overall dip for construction. That 7% sales drop, 12% profit drop. It sounds pretty significant for such a core segment. What's that tell you? Competition, market health.
Well, it highlights a couple of things. First, yeah, the market's super competitive. You've got global players like Komatsu, Volvo CE, plus lots of strong regional companies. That 7% dip might suggest things are maybe maturing in some regions, or perhaps some economic headwinds are affecting new projects, customer buying decisions.
Makes sense.
But here's the thing. The profit decrease wasn't that much bigger than the sales dip, proportionally speaking, only about a 5% difference, roughly. That suggests they've got a pretty solid cost structure, or maybe good pricing power helping cushion the blow. It kind of speaks to their ability to manage margins even when volumes soften a bit.
Okay, that adds some important context. So if construction industries is about building cities and roads, resource industries, sounds like that's where they're literally digging into the earth. Mining, heavy construction.
That's pretty much it. Resource Industries supports customers in mining, heavy construction, quarries, aggregates. They provide really high productivity equipment, surface and underground. And a key thing here is their strategy. Focus on highly productive, reliable equipment that gives the lowest total cost of ownership over its life.
Right, the long game.
Exactly. Their R&D is really focused on that long-term value. But there's a catch. In some developing markets, customers might prioritize the upfront purchase price more.
The initial cost versus long-term value dilemma.
Precisely. So CAT has to balance that value proposition against the immediate cost factor. It's an interesting dynamic. Performance-wise, in 2024, the segment had sales around $12.4 billion. That was down 9% from 2023. Again, mostly lower sales volume. But like in construction, it was partly offset by favorable price realization, that pricing power showing up again.
Interesting. So that focus on long-term value is their play, but they know cost matters up front too. Okay, shifting gears, the final big segment, energy and transportation. This sounds really broad. What falls into this umbrella?
It is broad, definitely. It covers a huge range. Think oil and gas, power generation, and yeah, data centers are a big part of that now, marine, rail, other industrial uses. Their portfolio here is massive. Engines, generator sets, turbines, locomotives, you name it. Plus, and this is important, remanufacturing services, extending product life.
Okay, and how did this segment perform?
This one actually saw growth. Sales were up 3% in 2024, hitting about $28.9 billion. And that increase was mainly driven by, guess what?
Favorable price realization.
You got it, favorable pricing.
Yeah.
Oil and gas sales were kind of flat overall, more gas compression, and turbine sales balanced out less activity in well servicing. But the really interesting part, power generation sales surged, especially for those big engines used in data centers, huge demand there. And marine and rail services saw more activity too.
Wow, data centers. I wouldn't have immediately thought Caterpillar for that, but it makes total sense with the power needs. Why is that such a boom area for them right now? AI, cloud computing.
Absolutely. It's a massive growth driver. Data centers need enormous amounts of reliable, continuous power, both prime power and backup. Caterpillar's large engines and generator sets, they're perfect for that. And as the digital economy, AI, cloud, as all that keeps exploding, the demand for data centers just keeps rising.
So it's a steady, high-value market.
Exactly. It really shows how they adapt their core strengths to new industrial needs. And something else exciting is happening with Solar Turbines. That's a CAT subsidiary. They're working with Chevron, testing gas turbines that run on high hydrogen fuel blends.
Hydrogen power. Okay, that's definitely looking towards the future.
For sure. It's a prime example of their investment in what they call expanded offerings and sustainability, trying to find lower emission power solutions for the future.
That's a great example connecting the segments to their bigger strategy. You mentioned those overarching areas: services, expanded offerings, sustainability. Why are these so crucial beyond the individual segments?
Oh, they're absolutely critical. Services, first off, that's a huge growth engine. Record revenues in 2024, $24 billion. And they're aiming for $28 billion.
Wow.
Yeah. And it's not just parts, it's the whole support package after the sale. Maintenance deals, digital tools like VisionLinky for equipment management. They have over 1.5 million connected assets now, using things like VisionLink more than ever. Services mean high margin, recurring revenue, makes the whole business more resilient, builds customer loyalty.
Sticky customers.
Exactly. Then you have expanded offerings. That's where they're pouring investment into core tech, autonomy, alternative fuels, connectivity, digital electrification. Basically meeting customer needs for reliability, durability, economic value, but also future-proofing their products for new demands.
And sustainability. That's relatively new as a strategic pillar, right? Since 2022.
That's right. And it's deeply embedded now. They're committed to developing products and services that, improve quality of life and the environment, helping customers hit their own sustainability goals. Think fuel efficiency, fuel flexibility, electric options. It's not just about compliance, it's driving innovation.
So it's really an ecosystem they're building, not just selling yellow machines, but providing ongoing support and future-focused solutions. Okay, that ties nicely into the financial picture. Given those sales dips in construction and resources, what do the overall 2024 numbers tell us? How healthy are they?
Overall, yeah, it's a nuanced picture, but ultimately very strong financially. Total sales and revenues landed around $64.8 billion. Now, that was a 3% dip from 2023, driven by that lower sales volume we talked about. And this is the key, that was significantly offset by favorable price realization.
That favorable pricing keeps coming up. What does that really mean for a company like CAT, especially when volume is down? Is it just raising prices?
It's more than just raising prices across the board. It's a sign of really strong brand value and market leadership. It means they can command premium pricing for their products, for their services, even when maybe fewer units are being sold overall.
Like a competitive advantage.
Exactly. It shows they have a solid moat around their business. Customers value the quality, the reliability of the CAT brand enough to pay that price. It helps protect their margins massively when volumes fluctuate. And you see that in the profit numbers. Despite the sales dip, they hit a record adjusted profit per share, $21.90. That's up from $21.21 in 2023.
A record, even with lower sales.
Yep. And their adjusted operating profit margin climbed to 20.7%. That's actually above their target range. JAP profit was also up, around $10.8 billion compared to $10.3 billion the year before. That increase, despite lower volume, came from that pricing power, plus not having the impact of a divestiture they had in 2023. It points to really strong cost management and smart pricing.
Those are impressive margin numbers, definitely highlights the pricing power. But are there any, underlying worries there if that sales volume keeps trending down?
That's the main thing to watch, absolutely. The strength in 2024 really hinged on that pricing offsetting lower volume. If volume continues to fall and pricing power weakens for some reason, maybe increased competition, economic downturn, then margins could get squeezed. It underscores why focusing on services and those expanded offerings is so smart strategically. Those areas can offer more stable revenue, potentially higher margins, acting as a cushion against the cycles in new equipment sales.
Like diversifying the revenue streams. Okay, so strong margins overall. What about cash flow? The actual cash coming in and out the lifeblood, right?
Absolutely the lifeblood. And here they look remarkably strong. Enterprise operating cash flow was a very healthy $12.0 billion in 2024. And drilling down, their ME&T machinery, energy, and transportation free cash flow was $9.4 billion.
ME&T free cash flow.
Yeah.
Why is that specific number so important?
Because the ME&T free cash flow is basically the cash generated by their core industrial businesses after they've paid for operating expenses and invested in capital assets. It's the cash that's truly available to, pay down debt, give back to shareholders through dividends and buybacks, or pursue other strategic moves. Hitting $9.4 billion is near the top of their target range, which is fantastic. It shows the core business is generating a lot of cash. And they ended 2024 with a strong cash position overall, about $6.9 billion in enterprise cash. Lots of flexibility there.
Plenty of cash on hand.
Oh,
Okay.
yeah.
What about their order backlog? That usually gives a hint about future demand, doesn't it?
It does, yeah. And their backlog actually increased. It went up to $30 billion at the end of 2024 from $27.5 billion the year before.
Interesting, even with the sales dips in some areas.
Right. The increase was mainly driven by energy and transportation again. Think data centers, maybe other power gen or oil and gas projects. Construction and resource industries saw their backlogs dip slightly. It's also worth noting they mentioned about $8.0 billion of that $30 billion backlog isn't expected to be filled in 2025, so that gives some visibility further out. But the overall rise suggests continued long-term confidence, especially in that E&T segment.
And dealer inventory. What's the story there? Are dealers stocking up or cutting back?
So overall dealer inventory went up slightly by about $400 million in 2024, but that's way less than the $2.1 billion increase they saw in 2023.
Okay.
And here's a key detail. Machine dealer inventory actually decreased by $700 million last year.
So dealers are holding fewer actual machines.
Seems like it. It likely reflects dealers being maybe a bit more cautious about future demand compared to the year before. Or perhaps delivery times are getting more efficient. Either way, it suggests a leaner inventory pipeline out there with the dealers.
Okay, so solid financials, strong cash flow, growing backlog driven by E&T, but maybe a bit of caution reflected in dealer inventories. Let's talk shareholder value and the road ahead. They have a reputation for consistent returns, right?
Oh, absolutely. A very strong reputation. And they backed it up in 2024. They returned over $10 billion to shareholders. That's through share repurchases and dividends. And here's the really standout number. They've paid higher annual dividends for 31 consecutive years.
31 years. Wow.
Yeah. It puts them in the S&P 500 Dividend Aristocrats Index. That's a huge signal of financial strength and commitment over the long haul. Dividends paid were about $2.65 billion in 2024. The quarterly dividends stayed at $1.41 per share, and they were active on share buybacks, too. They still had $20.1 billion authorized for future repurchases at the end of 2024, so expect more of that.
That 31-year streak of raising dividends is just remarkable. Speaks volumes about discipline. How do they actually manage their capital to keep that streak going while also funding growth? What's the strategy? They're very clear and disciplined about it. Top priority number one, keep a strong financial position. They aim for a mid-A credit rating. That's foundational, keeps borrowing costs down, gives them flexibility. Priority two, fund the business. That means operational needs and those strategic growth areas we talked about, expanded offerings, services, sustainability, investing in the future. And then, finally, return capital to shareholders. The goal is to return substantially all of that ME&T free cash flow over time through dividends and buybacks.
So stability first, then growth, then returns.
Pretty much. It's a disciplined sequence that ensures the long-term health of the company, which ultimately benefits shareholders through those sustainable returns.
Seems sensible. But how flexible is that? Say a major new technology pops up or there's a big market shift. Can they pivot quickly enough within that framework? I think there's inherent flexibility built in. Maintaining that strong credit rating and funding operations first gives them a buffer. The strategic growth bucket is broad enough to shift focus, like putting more into electrification or hydrogen if needed. And that goal of returning substantially all free cash flow. It's a target, not an ironclad rule. If a truly game-changing investment opportunity comes up, or if there's a severe downturn, they can choose to retain more cash. So the framework provides discipline, but there's room to adapt within it.
Gotcha. That makes sense. Okay, looking forward now to 2025. What's the crystal ball say? Sales, costs, given the mixed picture from 2024.
Well, they're guiding towards moderately lower sales to end users in North American construction industries. That's even though construction spending itself looks pretty healthy there, thanks to big projects and infrastructure spending.
So spending is there, but maybe fewer new machine sales.
Potentially. Resource industries is also expected to see slightly lower sales. They mention unfavorable pricing and slightly lower volume as factors there. But the bright spot continues to be energy and transportation. They expect sales there to increase, driven by both higher volume and favorable pricing. So E&T continues its strong run.
Okay, so a bit mixed on the sales front again. What about costs and investments?
They're anticipating some headwinds, unfavorable price realization in some areas, maybe higher depreciation costs. Also, other income is expected to be less favorable, likely lower interest income, and they won't have the positive foreign currency effects they saw in 2024. They're also planning for some restructuring costs, around $150 to $200 million, suggests ongoing efforts to stay efficient. Importantly, capital expenditures are projected around $2.5 billion, so they're definitely continuing to invest significantly back into the business for the long term.
Okay, so navigating some headwinds, but still investing strategically. What are the big challenges they call out, and how are they set up to handle them?
They acknowledge, they operate in a tough environment, it's highly competitive, it's cyclical. They specifically mention risks like commodity price swings, global economic ups and downs, government policies, trade rules, monetary policy, and of course, supply chain issues are always a potential factor.
Standard risks for a global giant.
Pretty much. And their answer to navigating these is really that strategic focus we've discussed. The growth in services, the expanded offerings, the push into sustainability, those help diversify and build resilience. And one thing they highlighted, which might sound technical but is important, is that management confirmed their internal controls over financial reporting were effective at the end of 2024.
Why does that matter to us?
It basically means they have strong processes in place to ensure their financial reporting is accurate and reliable. It's a sign of good governance and solid risk management, crucial for managing uncertainties in the market.
Right, confidence in the numbers and the processes behind them. Okay, so we've really unpacked Caterpillar's 2024. It's clear they're more than just a manufacturer. They're this global player focused hard on innovation, sustainability, and delivering shareholder value, all while navigating a complex world. From autonomous mining trucks to exploring hydrogen power for data centers, you really get a sense of how they're evolving to build the future, not just maintain the present, and doing it with impressive financial discipline. So what's the big takeaway here? As the world keeps needing more infrastructure, and as the energy transition accelerates, Caterpillar's position balancing that heavy-duty reliability with cutting-edge sustainability feels incredibly critical. It really makes you wonder, in this balancing act between growth and environmental needs, how will giants like Caterpillar keep redefining what building means? And who else will step up to innovate alongside them? What part of this global shift stands out most to you?